Welcome to the Talking Advisory and Client Solutions podcast. My name is Leah Crowley, and in this series we're taking a look at a range of topics that you might know a little bit about but want to get a better understanding of. We will discuss a range of topics like buying and selling a business, valuations, due diligence, debt advisory, sustainability, financial transformation, and a whole lot more. Last episode, we kind of touched upon, or I should say, Warwick touched upon due diligence, but we didn't really delve into it too much and thought perhaps a whole episode just about due diligence would be good so that people could get a better understanding of it. So in the studio today, we've got Nicholas Guest and Joel Dare as well. How are you guys going?
Very well, thanks, Leah. Great to be here and talk about diligence.
It certainly is, and it's a little bit chilly today, but it's very warm where we are, so...
Very warm, so you're not too cold and your brain's ready to explain all of the things that need explaining.
Always warm and humming.
Brilliant. So Nicholas and Joel, just give us a bit of a background on your roles at HLB, Mann, Judd.
Thanks, Leah. I am a partner within our corporate advisory division. I assist businesses and potential owners and or sellers of business approach transactions, giving them advice on the best way to either value a target business, identify a target business, and or proceed through that transaction process.
Oh, excellent. Well, you sound perfect for this episode. What about you, Joel?
Thanks, Leah. Yeah, so I'm Joel Dare. I'm a tax partner at HLB Mann Judd, and amongst other things, I get the pleasure of working with Nick on a range of transactions from time to time. So I work with a variety of different clients, from multinationals right down to really small, closely held groups. And one of the most fun things, I suppose, about what we get to do is be close to clients at times like this when they're doing a transaction or looking at a divestment, which is very important in terms of those life events. So, due diligence is one of the more fun things we get to do.
All right. So why is it fun? And also, can you talk through the process of due diligence?
Leah, I think diligence is fun because at its core, it's about asking questions and finding out about a target business, trying to identify risks and potential opportunities to support a business case to proceed with an acquisition.
This is obviously going to differ depending on what the acquisition is and the size of it and whatnot. But how long would the process of due diligence take for any acquisition?
I think the answer to that is longer than most people anticipate.
Yeah, right. Yeah.
Look, diligence is one of those things that until parties enter into it and start the process, it can expand. And that's why some of the things I think we'll talk about today is the importance of entering the diligence process in a really structured manner, and getting the right people involved and setting up some criteria before we commence to get all parties aligned.
Yeah, right. Can we just sort of have a really super general, because I imagine everyone's different, but can we have a general sort of process of what you guys go through?
Yeah, sure. So ideally we would like to get involved with a buyer of a business quite early on when they've identified their target, they've started to have some initial discussions with that target, and they're fairly keen to try and progress, but yet they've likely not yet entered to any formal terms in relation to that transaction. At that stage, we get to understand what the target business is that they're looking to acquire, understanding its size and scale, where it operates, understanding some of the key drivers of that business. And at that stage, we typically start discussing with potentially with the target directly or via their advisors to try and scope out this diligence process. We are very conscious that diligence can turn into a hugely expensive and time-consuming process, so it is scalable. And so it is through these sort of initial interactions that we try and identify the areas that are most likely to be of risk or importance to the transaction and design a process of diligence around that. And it's likely to involve multiple parties. So we typically come in as the sort of financial advisor. Joel and his team would be a taxation diligence. Legal diligence is also extremely important. And there could be other areas of diligence too, such as engineering or commercial or even sort of IP diligence, depending on what the nature of the assets are within the target operation. So it's through that initial scoping process that we work with the buyer to understand where the risks are, where the opportunities are, and who should be involved in that process. And then literally working through a timetable, a scoping discussion, and then getting all parties together to have a really robust understanding and agree who's going to do what by when.
So Joel, from the taxation sort of point of view, are you talking to the target business as well, or are you sort of working on behalf of the bigger HLB team who are doing the due diligence?
Typically, Leo, what we try to do is to work in together on a joint engagement, because often what we'll find in transactions or diligence is that there'll be a crossover between financial, legal and tax due diligence. So often these things are better from a client service perspective if we get a level of integration in what we're doing.
Yeah, and I absolutely concur with that, having that all parties approach. So we've got the buyer in the room, we've got their assembled team, and by having that jointly agreed scope, trying to minimise the crossover of activities and streamline those workflows. It also assists in engaging with the seller's representatives, because they were likely to have their accountants involved or their lawyers or their internal management teams, and trying to, as best as possible, minimise disruptions on those individuals is what we try to achieve.
Why is it essential that a buyer of a business undertakes a program like due diligence? Is it just so that you know what you're entering into? Is that it?
Look, at its core, typically a buyer prior to doing due diligence has been shared some information from the target. They might have been information that's been presented via an information memorandum or just via some discussions with a target business. The due diligence process is fundamentally wants to verify and support that information and representations that have previously been made. But it goes beyond that in trying to identify the unknowns. There may not have been disclosed within information. So trying to identify if there's any additional risks that a purchaser may be taking on if they would acquire a business. Also, there's opportunities to identify actual opportunities within the business as well, which would go into our value consideration and how we might be looking to value that business and the ultimate purchase consideration we may pay for the business. And there's also the start to think about, if we were to acquire this business, how would we integrate into their operations? How would we go about actually operating this business once we are the owners of the business? So that's the real importance of due diligence. One of the problems that we identify in occasions when a detailed diligence program hasn't been undertaken is that encounter buyer's remorse. So a purchaser buys a business, they go through to completion, they've paid the sum of money, and then they uncover, once they start to operate the business, it's not quite what they thought it was. And that's a real shame, because it's quite difficult often to unwind a business transaction once that's proceeded that far.
Yeah, I would imagine be near impossible. Or is it possible, but like costly and timely and
costly, timely, and unfortunately can end up in litigation.
Yeah,
and that's something which
no one wants to do that. That's not fun. It's just not worth it. Now, you mentioned something about I can't remember the actual way you said it, but sort of future opportunities within the business. So it's almost like you're trying to figure out what is potentially. Absolutely.
A buyer will often make some assumptions around a business. They may have seen the business in operations. They've had discussions with the management team. They've been provided some financial information and the like. But it's not until you can really get into that diligence process that you can see some more detail around how their how this business operates and how you may be able to integrate the acquired business into an existing business that you might own. There may be things that we call synergies, where can either be on the cost side or where there may be some common customers or clients to which you can provide a greater range of services. So they're all benefits to the combined business going forward. And it's often during the diligence process that you can identify those and start to plan how you'll be able to maximise those benefits after the completion of a transaction.
And the value as well.
Absolutely.
Yeah.
And that goes to how much we may be willing to purchase this business for.
Yeah, right.
Because when the diligence process is commenced, we may have entered into what we call the non-binding terms or an offer document of some sort, and to which we've proposed a value. And so during the diligence process, we want to really cement what that value is and does that still make sense after our findings from the diligence.
And Joel, I would imagine from a taxation point of view, that sort of valuing, you're quite involved in that bit?
Well, yeah, not so much the valuation piece, but certainly at that point, structuring the deal and going into it, there's a sort of a general idea of what we're buying. Is it shares or is it assets? And then once we buy it, how does that fit into our structure if we're thinking about from the buyer's perspective? And so tax will form a part of that, making sure that it's not less efficient than it needs to be for either party, and making sure that the commercial aspects of the deal don't get held up by any tax risks or tax obstacles.
Yeah, right. So almost sort of trying to see the problems before they happen so they don't happen.
Yeah.
Yeah, fair enough.
Or address them when they come up.
Yeah, right.
Find a way of dealing with it.
Yeah.
And that's a really good point, that with diligence, just because you identify a potential issue, it doesn't mean that will be a deal stopper. What it does provide is an opportunity for all parties, both the buyer and the seller, to understand how those risks can be mitigated, potentially contractually through the share purchase agreement or business purchase agreement. And that's where, particularly on the tax side, we can seek to minimise or mitigate historic tax risks, which can stay with an acquirer for a long period of time.
Really? Like how long are we sort of talking historically?
All things in tax usually will last at least 4 years as an historic risk, but there are a number of risks that you can inherit with an acquired business which will last virtually indefinitely. Okay. So there can be a particular tax risk or some incident that's happened before you've done your acquisition, but it can also be to identify processes within that business that, hey, you might not have had something happen now, but because you've inherited a range of systems to deliver your tax going into the future, that can be an issue which recurs and goes forward, and you acquire the entity with this way of dealing with its tax, which gives you a risk going forwards too.
Yeah, right. Who and when should a buyer engage to help with the due diligence process? I assume it's people much like yourself.
Absolutely. We are more than happy to talk to any potential buyers of business and help them start their due diligence process. In addition to someone such as ourselves who can help with the financial and accounting due diligence, and Joel with the tax due diligence, it's really important that a buyer has a great M&A lawyer who's able to assist them, someone who's experienced in the process, can help them through the diligence stage and then on to the actual drafting and negotiation of the legal documents for the business purchase. They may also want, depending on the nature of that business, to have some other technical expertise, whether they be commercial in relation to the particular markets in which a business operates. They may be in engineering if they have some very bespoke equipment and which we're going to take on in their core to operating the business. There can be some levels of engineering diligence around those specific assets. Likewise, at times it's important to get HR teams, so human resources specialists can come in and also add to the diligence process when there's large assembled workforces. It's something which is received a lot of media attention recently is the potential historical underpayment of staff, and that's can be a real risk for a business purchaser because, again, any of those underpayment liabilities would carry forward to the acquirer after they've purchased the business. And so it's really important to try and identify any of those potential issues during that due diligence process.
You also mentioned earlier IP as well.
Yes, so intellectual property. So we more and more business today may not be asset rich, i.e. they don't have production facilities, that they may be trading off their brand names. It could be some assembled software or the likes, which they've developed over a period of time, and being able to protect those IP assets following a purchase is also very important, particularly if they're going to be important to the future generation of revenues and profits for the business that we're acquiring. So getting an IP specialist involved to understand what patents or trademarks that may exist, or whether it's important to get those in place, and again, whether they're going to be transferred sufficiently and adequately to the buyer.
Interesting. Is due diligence a one-size-fits-all approach, or, is there I can't imagine everybody needs an IP, or even engineering.
That's absolutely right. And our approach is to scale the diligence. So to working with the buyer to understand what are the potential risks and the nature of the business that's being acquired, and designing a due diligence process that is absolutely specific to that target. And depending on the nature of the proposed structure of the transaction, again, the diligence may take a different form if there's possible, or there is likely to be the mitigation of some risks just due to the transaction structuring. Also, depending on the jurisdictions in which a business operates, if there's the business is simple and just operating from one site in one geographical location, it's likely to be a simpler diligence process than to a business which is operating in multiple locations, potentially with operations in foreign markets as well. And naturally, the diligence there is going to be more complex.
More complex, and would you then have to try and find appropriate experts or people to help with diligence in those particular countries?
Yes, absolutely. And so that can, again, form accounting teams, accessing sites overseas in foreign jurisdictions, or it may be legal diligence in those jurisdictions because they operate under different laws and regulations. So it sort of comes back to this initial scoping exercise and really working with a buyer to understand the nature of the business they're looking to acquire, and working through that early on in the process to design that diligence program. Because something that can come up is that if there's not an appropriate scoping exercise completed up front, and the sellers of the business may only allow a fixed diligence process, whether that be 2 weeks, 4 weeks, 6 weeks for this diligence to take place. If late in that process you identify some overseas operations or something else which is going to be core to the business, it can be a mad scramble to try and get that covered off.
Sounds like a nightmare. Those sort of like 4 p.m. Friday afternoon moments where you go, oh, this is another 50% extra work that we've just discovered.
That's not uncommon.
I bet.
Very frequent, in fact.
Yeah, right.
And coming back to one of our earlier points there about having regular conversations and discussions with all the parties involved in the diligence, we would tend to structure those on a weekly or more frequent basis, so that everyone can check in, share any matters that they've identified during the process to date, and then being able to understand if something that's been identified from a legal perspective potentially has a tax implication or a finance implication, and likewise sharing that knowledge as we progress can try and avoid those last minute scrambles.
So as the anxiety rises up through your body, we've all felt that before. Other than minimising transaction risks, are there any other benefits to the whole due diligence process?
Absolutely. I think it gives a buyer a great opportunity to actually get a detailed understanding of the individuals who are within the business they're acquiring. So they get some exposure to the management team there. It can help them plan for how they will interact with those individuals post-completion. It can also give them a great understanding about those synergies, which may be able to add additional value to their business. And often they find or identify synergies which they hadn't even contemplated when they first started along the acquisition process. So
that must be pretty cool.
It is. And again, coming back to some of the fun parts of the diligence is exactly that, identifying where there are those potential synergies, which can be a win-win for our buyers.
And also the staff or the managers in the target business, because suddenly they may be feeling a bit stressed, but then suddenly they're like, oh, we've got something to offer that they're excited about.
Look, absolutely. And I think, as we're all aware, people within a business are so critically important. The vast majority of buyers of businesses want to keep the management teams and the staff in their target business in place. So trying to reassure them about their plans for them post-acquisition, letting them know that their jobs will be secure and that they have the opportunities to continue to thrive in their roles and potentially grow their experience as well. It can be a great relief for those individuals, but also a real benefit for the buyer to get those secured.
Yeah, amazing. So, like, as an employee, if someone comes into the business and says, "Oh, look, we're looking to buy it, but your job's safe," a lot of people would freak out at that, wouldn't they?
Well, sometimes yes, but look, one thing I certainly see from the tax side is that I get involved a lot with employee share plans and option plans. And what they do in particular is they offer all those employees a share in whatever that capital value is. So, yeah, you're quite right to say in a lot of cases employees will go, what does this mean for me if I still got a job? But in other cases they'll be saying, hey, guess what? There's this big capital event coming and I actually will share in the benefits from that. So look, it actually can be a case where lots of employees are really keen about the potential upside risk of the fact that you're going to do diligence and potentially be subject to a transaction.
And another reason why we believe it's really important to have a planned and a structured approach to diligence is to avoid unnecessarily concerning employees or scaring off the target business. Due diligence by its nature is rather intrusive. There's a whole lot of questions being asked of a seller of a business. They can be bombarded from legal questions, taxation questions, accounting questions, and it can become overwhelming. And they have a phenomenon we call deal fatigue, where after we're 4 weeks into a diligence process and the next round of questions come out, it's not uncommon for a seller to put up their hands and say, oh, I've had enough. When's this process going to stop?
Wave the white flag, you can have it.
Yes, and that's a risk for everybody, because at that point in time, everybody's invested in trying to get this deal across the line, but it is intrusive. By having a structured approach and trying to as best as possible minimize those sort of events is beneficial for everybody, and trying to reassure them. We do things such as having these all parties meetings, and that might involve getting the seller involved, getting their advisors involved as well, and really having a bit of a heart to heart and say, look, we're trying to minimize our risks on this side. Understand we've asked questions, and this is the fourth version or the fifth version or sixth version of a Q&A that you're going through. but try and explain why that is happening. And through that, you can often find out the real crux of an issue, and then you can start working through a solution to potentially minimise that risk. And that might be via structuring within the purchase agreements to provide what they call warranties from a seller, which minimises the future risks to the buyer. It's also important to have a great deal of discretion through the diligence process. So often it's not until very late in the process that the staff within a selling business become aware that the business owner may be wanting to sell that business. So again, being conscious from the diligence side not to disrupt those individuals, and streaming all the questions in appropriate manner and maintaining a confidentiality, because you don't want to disrupt that business. There can be risk if it becomes aware in the market that business is looking to sell. Their customers or their suppliers and their employees may be unnecessarily concerned.
Yeah, you don't want to spook everyone when there's no reason to spook people.
Exactly right. Yeah. And I think it's human nature to an extent that where there's potentially for speculation, it can go out of hand if there's not some clear communication around that.
Yeah, people love a good gossip.
They do, and that can be detrimental to a deal. And so that's from, again, working with experienced due diligence providers, whether that be on the accounting, the tax side, the lawyers, and so forth. Having teams in the room who are experienced in undertaking these processes can help minimise the risk that unnecessary information is going to be leaked into any of the market.
Well, it certainly sounds like a very thorough process, which should be really, I think, comforting to both sides of this, any potential buyer or seller.
Absolutely. And look, it can sound like it's an adversarial process, but the best outcome most of the time is going to be when both the buyer and the seller and their respective advisors work conducively together to get to an outcome which is going to ultimately be the best deal for the seller and sufficiently cover the risks for the buyer. So
try not to get that deal fatigue. Just try and work through it. Push through.
And look, yes, everybody. Yeah, deal fatigue unfortunately can be unavoidable, but everybody does what they can to minimise those shocks.
Yeah, awesome. Well, thank you both so much for coming on and having a chat about this. I feel like if someone listening didn't really understand what due diligence was, I'm sure they do now, or at least have a better understanding so they can go through the process or even approach and think about the processes of buying or selling a business. So Joel and Nicholas, thank you so much.
Thank you, Leah.
Thanks, Leah. It's been a pleasure to join you.
Nicholas Guest and Joel Dare's expertise and knowledge is part of HLB Mann Judd's personal wealth management services. For more information, please visit our website hlb.com.au.